Widow's tax traps, no big deal, huh? Huh? Academics, man, academics. Anyway, so we're going to dive into this and then stay towards the end of the video. I'm going to share with you a story or two about my awakening when it comes to the widow's tax trap, Social Security taxation, stuff like that, that I did not get from an academic. I got from a life insurance salesman. I'll never forget this. Anyway, so stay tuned. So we're going to come around here. We're going to go to, we got Diane and Danny sample. Diane is 672, Danny 74. We're going to kill Danny off at 85, so Diane will be a survivor, a widow for a number of years, all right? I think 5 or 6 years. The only net worth they got is Diane's IRA. It's in her IRA right here at $500,000. That's it. And they both got Social Security of Diane's got $2,000 Social Security, Danny's got $2,500 in Social Security. All right. So what we're going to do is we're going to come to cash flows. And by the way, if you haven't, again, as a seamless or a shameless plug on my books that I got, if you haven't bought them yet, you're wrong. And you know they're getting a little bit dated now, but the concept is still absolutely valid. Tax bonding retirement account is it's basically a pamphlet is what it is. 75 pages, 74 pages, tax bonding retirement account. You can retire on Social Security, 114 pages. You should buy both of those. They're all in the link to the Doobie Duke. Anyway, so all right, so let's go into this. So we got we're going to come down to cash flows, and we're going to show you what's going on. So here comes their income inflows. That's their Social Security. So you see Social Security for Diane $2,000 a month, for Danny $2,500 a month. But they need right here. Their expenses are $50,000 a year. They're just taking. They have a 5% expense, or excuse me, they have a $50,000 a year expense. All right, with me so far? Because Diane is 73 now, she does have RMDs. Remember, your RMDs are based on your age, when you have to take them. So for most of us, it'll be at 75, but because I just have her older, it's at 73. All right, so she has 18,000 of RMDs. They got $54,000 of Social Security. All right, so we're going to come to the taxes. That's 2026. We're going to come over here. We're going to look at a 1040. And we're going to say, look, they got $54,000 of Social Security, $18,000 of RMDs. Of that, so that's what's that? $74,000 of income, essentially. $73,000 of income. Of their Social Security, only $7,500 is subject to taxation because of how provisional income works. Anyway, so they got their AGI right here is you take the $7,500 of Social Security taxes plus the $18,000 of the RMD. Their AGI is $26,000. All right, but they get $46,000 of standard deductions. All right, because of Trump. Yay for Trump! So they pay no tax, as you can see right there. They pay no tax. So we come back to we go back to cash flows, and we're going to show you they pay no tax. Shocking. All right. Let's go down here, and we're going to go to summary, and there's no tax. All right, so now they start paying a little bit of tax here because their RMDs are getting a little bit bigger. All right, their Social Security is growing, and as such, they're kind of starting to outgrow. Let's go to 2031. Actually, no, I'm going to scroll down here. We're going to go down to 2036. 2036, let's go to 1040, and I'm going to show you something else here. We can go to 1040, 2036. This is the last year where Danny's still with us, all right? So now they got some interest income because we didn't have to do that, but I'm going to do it anyway. So they got $3,000 of interest income. They got $31,000 of RMDs, $31,000. They got $68,000 of Social Security. So they got over basically $100,000 of income. Yeah, over $100,000 of income. Even that, though, only $27,000 of their Social Security is subject to taxation. So about 40% of their Social Security is subject to taxation. So we take our taxable Social Security and RMDs, our taxable interest income, and our total AGIs, or in this case, total income, but it's also AGI, $61,000. They have a standard deduction of $46,000 at this stage. Remember, the bonus standard deduction goes away in 2028, I think. 2029, 28. So they still got $46,000 of standard deduction. All right. So their AGI, their taxable income is only $14,000. All right. So on $100,000, they're only paying $1,400 in tax. Not too shabby. If we actually go to our estimated tax, you'll see right here, effective tax rate, excuse me. Their effective tax rate is 0.4%, something like that. What's that big bump right there? I wonder what that would be. All right. Everybody with me on that? So now let's go down to 2030. We're going to show you here when Danny dies. And we're going to show you what happens in 2037. Taxes more than doubled. So now Danny dies. Diane loses her Social Security. She retains Danny's, the higher of the two. All right, so right there you can see income from Social Security. It's her survivor benefit, $39,000. All right, she retains Danny. She loses hers. I know it says in here Diane's Social Security. Literally, it's semantics, but it's essentially she's losing hers and gaining his. That's all there is to it. She still has RMDs at $33,000. So her total inflows before were $100,000, which didn't include interest income, by the way. Now it's $72,000. All right, so that's a significant decline. That's 28% less as her total income. All right, her expenses have also gone down, all right, by $16,000. That's just a fact. But her income has gone down significantly, 28%. Yet her taxes have gone up more than double. Her taxes are now $3,900 on 28% less income. Why is that? Well, let's go to 1040. And what year is this? This is 2037. So remember, 2036, how much of her Social Security was subject to taxation? $68,000 of Social Security between Danny and Diane, only $27,000 subject to taxation. 2037, $38,000 of Social Security, of which $23,000 is subject to taxation. So now her AGI is $60,000 because she still has RMDs. All that flows to your line 15 or line, what is this? Line 11, excuse me, for AGI. Line 15 is your total taxable income. But anyway, line 11. So her AGI is $60,000. Previously, her AGI was $61,000. Even though she made a lot more money. All right, so her AGI is basically the same as what it was before, but now she gets one standard deduction, not two, and so now her taxable income is $35,000, whereas before it was $14,000, and so that's the married filing jointly, or the singles, the widow's tax trap, because now she has the same amount of AGI, but her taxable income is significantly higher because she is a single taxpayer. $35,000 is her taxable income, whereas before it was $14,000. So her taxable income more than doubled, and of course her taxes did as well. Not too shocking there, but it's going to get even worse. All right, we're going to have Diane take. She goes, and this is what I talk about in my book right here again. She wants to take a $25,000 distribution to go hang out with her grandkids in, I don't know, freaking County Cavan in Ireland. All right, so she's going to take $25,000 in 2038. Watch what happens here, and we're just going to go to retirement, and you're going to see a big taxable jump. All right, so cash flows, and we're going to go to here, summary, and you can see this right there, that $25,000 distribution. So she took $25,000 out, and it added another $4,700 of taxes. All right, you can see it right there. So we go to our trusty calculator. We go 4,700 divided by 25,000. That is an 18.8% effective tax rate on that amount of money she took out. All right, so let's just look at the tax code here. You can see a big jump. Oh, what's that big jump? It put her into a, right here. Actually, I want to go right there. That big jump put her into a 22% marginal tax rate. All right, and we look at the estimated tax. You can see that big jump right there because of that $25,000 distribution. We look at the 1040. And we go to 2000, I think it was 38, was it not? Was it 38? Yeah, it's 38. And you can see now she has $8,600 of taxes. Her total income, $40,000 of Social Security, $60,000 of IRA distributions. Her total income, in terms of how much she actually has, is $100,000, which was the exact same amount roughly that she had when she was married filing jointly with, what's his name? With Danny. Right there, $100,000 of total income. Now she has $100,000 of total income. When she was married with Danny, she had paid $1,400 in taxes, but now she has $100,000 of income as a single payer. She pays $8,600 in tax. So she's paying $6,000, $7,000 more in tax for the same amount of income. That is the widow's tax trap. To say otherwise is just to be ignorant of the tax code. I don't know what else could possibly be. So now let's just say, okay, let's say she took that the $25,000 distribution. Instead of 2038, we're going to say in 2035 when she's still married to old Danny. All right, there we go. Boink. And you're going to see what happens to her tax. Remember when it was $8,600 before, and now her total tax is right here. Cash flows, summary. And you can see her taxes when right there, 2035 is $6,300. All right. So that $25,000 distribution cost her significantly from a tax perspective. But it gets even worse. Even without that distribution, you can just see right here. Her taxes, because she's a widow now, are significantly higher than they ever were. They were $922, $675, now they're $3,600, $3,900, $4,300. Her taxes as a widow jump up significantly, even though her income went down significantly. There's no arguing this, and it's just silly. Again, if you're talking about the uber wealthy, you can make that argument, but the reason is because how the provisional code works, the provisional income. And again, if you don't know it, you should read my 2 books, and I've done a million videos on the provisional income. Essentially, this is where the tax torpedo comes in and all this. Yeah, again, if you want to talk about the Martha Vineyard crew and the freaking Marin, California, whatever the hell that is, by all means, by all means do so. The vast majority of us don't live in those rarefied airs. We don't. And as such, we have to know the tax code better than academics because we're not super uber wealthy. All right. So my story here was, and don't forget to smash that like button. When I will never forget, I had been a CFP for 7 years, something like that. I've been a Series 7 licensed guy for 12, 13 years. I got my Series 7 in 99, I believe, and my Series 6 in 98, something like that. I worked at Vanguard, worked at Schwab. And I was working in Center City, Philadelphia in 2012. And this guy came in, one of my clients is a captain in the Navy, and he gave me this PDF file. He goes, Josh, I'd like for you to read this and see if you can't debunk what this life insurance guy is trying to tell me. I was like, life insurance, that'd be easy to debunk. These guys don't know what they're talking about. They're just salesmen. And I said, what's he talking about? He goes, well, he's trying to say that if I can set up my accounts correctly, I won't have to pay any tax at all in retirement and on Social Security and all that. I said, no, man, Social Security, 85% of your Social Security is subject to taxation. We all know that. Anyway, so he goes, just read it for him, would you please? I said, all right. And I put it on my shelf for a couple weeks, and he emailed me. He goes, have you read that yet? I said, no. He goes, dude, just do me a favor and read it. So I said, and I like to read this stuff. So I always come home and I take stuff with me all the time, and I read it when I'm sitting on the pot, when I'm in bed, when I'm in the morning. I read all kinds of stuff. American Foreign Party, Trade Mess. I just got a million different things to read here. 100 years of U.S. consumer spending. So I'm a reading kind of guy. So I read it. And to my chagrin, I was stunned. This life insurance guy was correct. You don't have to pay tax on your Social Security and other things if you know how the tax code works, especially when it's just a provisional income. I said, well, how did I not know this? I never learned this at CFP school, never learned it at Vanguard, never learned about it anywhere. And for Journal for Financial Planning, so I emailed this guy, William Reichenstein. I don't know if he's still around, but he was a professor of finance at Baylor who did a lot of stuff on tax planning and Social Security. And he used to write in the Journal for Financial Planning all the time. And he and this other guy, another Bill guy, created some database on Social Security stuff. And I said, I just emailed this guy out of the blue. I said, man, you ever heard this provisional income and blah, blah, blah? And, I'm not trying to put words in his mouth or make him belittle him, but basically said, no. I said, man, this guy is saying that this is what this guy, life insurance guy, is saying that blah, 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 you can make it tax-free if you know how the provisional income works. And Reichenstein used to write all the time in the Journal of Financial Planning. And I said, man, there's got to be more. So I started looking in the history of the Wall Street Journal and stuff, and there's just like one article that I could find that talked about this from CPAs, Robert Keebler, all these guys I follow. It was just one. And I think it might have been Keebler. I can't remember. I was like, how do people, what the hell, man? How has this not been front and center in financial planning circles about how you can reduce, if not eliminate outright, your taxes in retirement? I couldn't believe it. And everyone's just defaulting that 80% of 85% of your Social Security is subject to taxation, which is the whole point why I started this YouTube channel, because it's just not. I'll never get that. And then I learned about the tax torpedo, and I was like, I couldn't believe it. Reichenstein has since done articles on this, the tax torpedo, absolutely. Provisional income tax rules. But this is in 2011 or 12. No one was doing it. There was just one article. This is before we had ChatGTP and Grok and all that stuff. But, so just your basic going hunt and peck and research on this. But I was like, how do people not know this? And so then I was like, freaking, John the Baptist is sharing the word. I was like, I got to share the word, which is why I started this YouTube channel. I started doing books and stuff like that. I said, I got to share the word on this. If you're middle class, there's a better way to prepare for retirement than what you've been told about deferring everything. You're not going to escape the taxation necessarily, but 10% tax is better than a 20% tax. No one would disagree with that. A 10% tax today is better than a 20% tax in the future. A 10% tax today is the equivalent of a 10% tax in the future, potentially, given a bird in the hand is always better than two in the bush. But that's not what we're talking about here. We're talking a 250% increase in taxes for a widow versus a essentially 10 or 12% tax today, depending on what your marginal tax rate is. Anyway, seeing academics just be ignorant of this stuff and then imply that the widow's tax trap is some kind of life insurance financial planning scam to sell people on their morality as being husbands who want to protect their wives. That's what, this idiot. We don't, you guys are was discriminatory against surviving spouses, thinking that they're just little violets that shrinking violets. No, I don't care if you're a woman or a man. If you're a surviving spouse, they just happen to be women more often than not, because many marriages are older man than a woman. It's just a fact. My own marriage is like that. My wife is 4 years younger. In most marriages, the man makes more money. Oh, but it's a gender gap. Well, that's just idiotic, dude. Anyone who says that doesn't know what the hell they're talking about. Anyway, all right. God bless. Smash that like button. Love to hear your thoughts. We'll see you.